Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Okay, welcome to The Wealth Flow. My guest today is Geoff Stuhr. Geoff is a seasoned real estate investor, a fund manager, an advisor with over a decade of experience building wealth through cash flowing rental properties. As a managing partner, principal, and co-founder of Smart Asset Capital, Geoff has been instrumental in growing the firm to over $50 million in assets under management since its founding in 2019. His experience has spanned over multiple asset classes, including single-family, small and large multifamily, self-storage, office, retail, industrial real estate. Geoff has been directly involved in over $100 million worth of real estate transactions. In addition to his investment work, Geoff is also the author of The Wealthy Limited Partner, a forthcoming book early 2025, designed to educate investors on passive real estate investing through syndication and private funds. He also is the co-host of a Winning Wealth podcast where he shares insights on building financial freedom through strategic investing. Geoff, I'm looking forward to this. Welcome to The Wealth Flow.
Thanks so much, Keith. Thanks for having me. I greatly appreciate it, and I'm looking forward to it as well.
Yeah, me too. And I always like to start with our guest and kind of where they grew up and your background and what eventually led you to this wonderful world of real estate investing.
Yeah, I'll try to be not so long-winded. Sometimes I can go on and on when I get an open-ended question like that and do quite a bit of talking. So I'll try to button it up and be concise. But I grew up in a suburb of Milwaukee, Wisconsin. It's called Franklin. And I went to school in the area. I've played sports my whole life, so I played football in college. I didn't know exactly what I wanted to do, but I had a previous football coach that was in sales. He had an awesome boat and a nice house, and so I talked with him kind of as a mentor as I was graduating school, and I had this big void that was in my life without playing football anymore. And so I wanted to attack my professional career. And there's a lot of things that sort of happened along the way in my life that sort of led me into investing in alternative assets. But at first, I knew nothing about that. And I knew that I wanted to increase my income. And so I started to learn everything I could about sales, and so that I would actually have some money to invest. I started in med device sales, and I was in Fargo, North Dakota for a year and a half. Then I moved to Chicago for a different sales role. And around that time, I started to actually figure out sales. It took me a while. At first I kind of just thought I could go be personable and charismatic, but I quickly learned that, there is a systematic approach to driving revenue and growing a business, or a sales territory for that matter. And I started to make commission checks. I realized, at a relatively young age, I think I was, so I'm a little bit younger for my age. or I have a summer birthday. So uh, I was maybe 23, 24, and I realized that when I made commission checks, if I didn't have a plan for what I was going to do with that money that was sitting aside, it would disappear pretty quickly. As a young single guy in downtown Chicago, and I thought, okay, well, this is fun, but I've got to be responsible. I do have goals, and I really want to be um, disciplined about building my net worth and building my income. And so I had a friend that was investing in real estate, and he was buying duplexes, and I had talked with him more. That friend is now my business partner at Smart Asset Capital. But at first I was a client of his. And so he was a real estate agent focusing on in investment properties. He helped me buy my first duplex, my first few duplexes, and I was hooked. I mean, I didn't know much about it. I let him kind of talk me through the numbers. At this point in my life, I was studying everything I could about sales because I wanted to
Right.
grow my income. Then I started, after a while, I started transitioning to really studying real estate investing, listening to Bigger Pockets, reading as many books as I could on the topic, and I just got addicted. And I bought my first duplex. I remember, and at this point, I was self managing everything that I bought, and so I collected. I bought this duplex, listed it for rent immediately. One of the units was vacant. I had a bunch of showings that day, and picked a great tenant. He came over with his security deposit, his first month's rent check. And there was like a little bit of a gap before I needed to make my first mortgage payment, which was like, I don't know, a month or so later. And I
Yeah.
was like, man, I'm going to be rich. I am a real estate mogul now in the making. And, there's been a ton of lessons along the way, but that's really how I got started. I started, in sales, trying to focus on how do I grow my income, and then, um, you know, how do I take that income and put it into some asset that maybe I like the illiquidity of it. To be honest, I didn't necessarily trust myself at 24 years old or 25 years old to be able to have that have lump sums of money sitting around that I could access, because I didn't know if I'd make a good decision with it. But if it's already in a cash flowing rental property, then it's sort of out of sight, out of mind. It's doing its thing. It's multiplying and building value. And, back then, this would have been, I think, 2014 or so, 2014, 2015. I graduated in 2011, so something around there. And, at that point, I felt like, looking back, at least, you could have almost thrown a dart at a map and bought anything, and it would have, at least in a decent area,
Yeah.
and it would have appreciated in value. And so I have, I owe a debt of gratitude to my business partner Adam, and who was my real estate agent at the time. And I also got a bit lucky with appreciation, and I learned a lot of things along the way to get me here. And I'm happy to talk through the journey as well.
Yeah, yeah, sounds good. Yeah, it is amazing. It's kind of funny now that the landscape has changed just a little bit. You think about when you started, and if somebody was to say start around the end of 2022, or possibly the beginning of 2023, somewhere in that time frame when things just shifted a little bit, and the outcome may have been totally different. It may have looked at, hey, here's this duplex, and then decided that real estate's not for you. And so that's awesome that you got to start when you did. And I would like to hear about some of the journeys along the way. It sounds like too the initial one went pretty well. You even got your renter, the deposit, and everything before your first mortgage payment. So that's awesome in itself. I would be curious to know, with that one, what was the plan after you bought that first one? Was it to go turn around and buy another duplex, and then maybe one every, year or two, or what was your initial thought?
Yeah, it's funny that you said that, 'cause that's spot on what my plan was. I was going to I had a 401k that was slowly started building.
Hmm.
But I was like, you know what, I don't, and I did a little bit of investing in the market in terms of just, not necessarily picking stocks. I was just dollar cost averaging a little bit each paycheck into index funds, and particularly ones that have. I'm a big cash flow and yield guy. That's sort of my whole thing, and so it was dividend producing in index funds a little bit, but the majority of my wealth building plan was going to be in real estate. I was hooked on that first one, and then I started getting more and more intel about real estate investing. So I was actively doing it, and then I learned that my grandma, and she had passed away a little bit before then, and I realized then that she was actually married before she was married to my grandpa. So she had a first marriage, and her husband actually passed away in a car accident. And I guess I didn't really know the whole story, but she took the life insurance money and bought a bunch of duplexes, or bought a few duplexes, and then built a little bit of a real estate. That's why I say sometimes real estate's in your blood. Like a lot of times, the people
Yeah.
that a lot of friends of mine that have done really well in real estate, you can sort of track it back to other people in their family that maybe either got them into it or whatever. Well, I didn't know that my grandma was a real estate a landlord, but that was what she did for her life. And so knowing that, then and thinking about how easy it was with my first duplex, and then I bought a second duplex. I think within a year, and my plan was just going to be to buy, 1 to 2 properties a year and grow that over time. And I did get very lucky that the first two that I bought were, kind of slam dunk deals. And I say that sometimes it's better to be lucky than good. And I certainly do think that sort of propelled me along this journey. But that being said, when you start a new business, even if it's not the right timing, I do think that there are ways to prevail, and there's a lot of people that, Steve Schwartzman, Blackstone. I mean, they started not in a great time. So there's a lot of stories of people that have been wildly successful, even though they weren't sort of able to time the market. I don't think people should ever try to time the market. And I can kind of talk through our experience over the last few years as well, but the plan was to buy, 1 to 2 rental properties a year, and slowly that just I was kind of addicted to real estate and evaluating properties, and that just sort of started to scale. So I had bought, you know, um, I don't know, I think I was at eight or 10 units that I had bought by myself, and then I started looking at potential partnership opportunities, joint ventures, and from there, we did that for a couple of years, and then we figured out what a syndication was. We did our first syndication deal, and then started to really build this business, and that's when it became something that it wasn't, just sort of just a side hustle for me. Yeah. Yeah, yeah. So I think we did our first joint venture deal in early 2019. And then that was sort of to prove out this model. So we had already started thinking about um, allowing investors to co-invest with us and raise money in a syndication format. But we wanted to buy a bigger apartment building in a joint venture model, and then sort of prove out this value add business plan. Like before that, I was only buying duplexes and a single family. And then we bought a 34 unit apartment building. It was me, my business partner Adam, and my dad. And we were each a third partners. Put a third of the cash in. I think my dad's only been there a couple times. That property we still own. It does really well for us. We sort of proved out the value add business strategy plan with that 34 unit. And then after that, we raised capital and went and bought an 89 unit apartment building.
Oh, nice. Okay. And what year was that you bought the 89 unit?
That was in 2019 as well. I think the 34 unit might have closed in late 2018. So I think I bought my first property in 2014, 2.5, 3 years out of college. And then I was buying, 1 to 2 properties a year up until like late 18, bought the 34 unit, and then we started the syndication business. And since then, I haven't bought any rental properties in my own personal portfolio. I bought a house and a condo, for me to live in over that time. But other than my own personal residence, all of my investing since late 18 and early 19 has been either in a joint venture or syndication, or now we have an active real estate fund.
Okay. No, that's fantastic. And on the one that you bought in 2019, the 89 unit, because you had mentioned you still have that 34 unit, it's doing good for you. Did you end up selling the 89 unit?
Yeah, I got a lot of lessons on that one. For anyone that listens, if they want, not to push anyone over to our channel, but we have a podcast. It's titled the 89 unit apartment building from hell. So we I look back now and we break the whole thing down and talk through the lessons learned, but that was not a great deal for us. We were, as I said before, I'm very attracted to yield. I think a lot of investors, when they're early in their investment career, they maybe overlook certain things in the real estate world when they see a high cash on cash return potential. And that was certainly us. It was not in a great area. I had just read the book Emerging, I think it's called Emerging Markets or Emerging Real Estate Markets by Dave Lindahl. He also wrote a book called Multifamily Millions. And I had thought that this area was emerging. There was a YouTube video that had come out by the sort of the neighborhood. It's called the Near West Side Neighborhood Partners Association. And it really looked like they were trying to revitalize this area. And I think it was trending that way. And so, it wasn't completely us making a horrible investment decision. I think we had a little bit of happy years. We bought from a group that was much more sophisticated than we were. There was essentially what happened with that property I'll explain it in the next minute. It was a Fannie Mae loan. They require these buildings to be 90, they call it 90 for 90. So 90% occupied within 90 days of the closing. This sophisticated group knew that. They kind of filled it with tenants that we really wouldn't have wanted. And so throughout the course of, May of 19 through the end of 19, we spent a lot of time and effort on trying to rebrand the apartment building with a new signage, new website, new sort of common areas remodeled. We had a whole plan for unit turns to remodel the property, but we really blew through our CapEx budget because we did not anticipate having to evict as many tenants as we did. And that property was kind of known as a problem property in that area. I had literally walked through the apartments down the street from them, and I got a sense for how they were operating. And I think ours was just we had a number of bad apples in the bunch, and we had to evict a lot of them. And those tenants did not, maybe leave the way that you or I would. They beat the hell out of the property. So we ended up blowing through our CapEx budget, and we did not raise enough money for capital reserves. We ended up having the three partners, me, myself, and Adam and Brock, had to basically take out a personal line of credit and float this property along with the property management company that we're vertically integrated with. So we have Adam's brokerage, Smart Asset Realty. We have Smart Asset Property Management, and then Smart Asset Capital. That was the first deal of Smart Asset Capital. And luckily, we were vertically integrated because we were able to keep a lot of costs in line along with our line of credit to float this property along. And as we got through the end of 19, we're like, man, we're sitting in a great spot. We got the bad apples out. We don't have anything left from CapEx, from capital reserves. In fact, we're negative on that. Like, we're
Yeah.
using this line of credit, but we thought really, we're in a great spot going into 2020, and then the pandemic hit, and that property in that area was quite susceptible to just the sort of dynamics that happened within the pandemic. There was a ton of uncertainty. A lot of tenants were saying, well, we don't have to pay rent anymore or whatever. So we struggled quite a bit through 2020. We ended up selling the property to a very big landlord in that specializes in kind of like Section 8 housing and apartment buildings in the Milwaukee area. We didn't lose an investor dime. We sold it and basically paid investors about 10% on their money over 2.5 years. So nothing great. They probably came out with a 3% IRR or something like that. But that being said, I wouldn't trade that experience for the world. And since then we've done 25 plus deals through syndications and in our fund. I've invested as an LP in other deals. Having gone through that experience and subsequently the next deal that we did as a syndication model in late 19 ended up really sucking too. Again, we didn't lose any investor capital, but our first two deals were complete duds. And I'm here to tell people that even if you don't have a ton of success right off the bat, there's ways to navigate it in real estate. It's incredibly important to maintain your reputation, be very ethical, very transparent, and you can get through it. Things get easier. I was sitting around in 2019, 2020 thinking, shit, we're going to be done before we even got started. And,
Yes.
since then we've done a lot of really great deals and we've had a lot of home runs that have more than, offset the losers. But those first two deals were pretty tough. Happy to talk about the second deal too, if you want, or if you have questions about the apartment, I can go through that.
Yeah, maybe just a comment quite honestly, the fact that you mentioned it, but you said you were able to return the investors' capital. Maybe it wasn't the best return, but there's a lot of investors out there today that would probably wish that they were in one of your deals and only getting the 3% IRR compared to what's happened with some of the others. I think that's good. And while you wouldn't have wished upon anybody, for that to be one of the first two deals that they've done, the experience that it gives you is incredible. I mean, you're really not tested until you have to face that adversity. And so kudos to being able to get through it, to be able to take out a line of credit to get through it. A lot of people wouldn't have, stuck their neck out there to do that. But you guys did and held on, and you were able to get your investors out of the deal. So congratulations on that.
Thank you very much. Yeah, I mean, for us, we want to be in this business for the next. I don't know if I'll ever retire, but so the next 50 years, whatever, right? So we always looked at it from the beginning as a long-term game, and we knew that our reputation was on the line, and we had to do everything that we could in our power, even though the risk was quite high for us to be able to do that. And at that time too, we had a lot of. I mean, it was friends and family money, right? It was $10,000 minimum checks, right? So we had a lot of different $10,000 checks in that deal that we had to, really make sure that we protect as much as possible. And then the other part of that too is I would never invest with someone that I don't want to say I'd never invest with someone, but what I was going to say is I would never invest with someone that hasn't truly been tested before. That's not the case. Sometimes you just bet on the people, you know them, you trust them, you think they have the right moral character and the right work ethic, and they're smart enough to figure it out. But there is a huge advantage to truly being tested, in a
For sure.
commercial real estate deal before, and not only once but back to back twice. I think that goes a long way. So we kind of always there was a lot of late night calls, a lot of early morning calls, a lot of staying up at night and wondering, how this is going to unfold. And I'm glad. And really, that was I wouldn't trade that experience because it helped to teach me that adversity doesn't have to be um, a negative thing, right? Like adversity and finding ways to work through adversity can be a very positive benefit for you later on in life. And so anytime that, we come up against a tough situation, and we do on a very regular basis nowadays too, um, and this could be personally or professionally. I've gone through some personal adversity as well throughout my life, and everyone has. And the more that I've leaned into it and tried to be solution oriented and had an optimistic, positive approach and just worked my tail off, the better things gotten. And it's never quite as bad as it seems. And it's, the wins are never quite as good as they seem either. But so I've really learned that lesson and had that sort of burned into me, and I think overall it's been very good. And I think there's things that had we not have gone through that scenario, or had we had started investing a little bit later, um, who knows how it would have turned out. I do know that there is a lot of syndicators in the news that that you hear about, Wall Street Journal, wherever else, where they're going through some really tough times, and maybe their investors' capital is upside down. And so that is something that we keep very much top of mind.
Yeah, for sure. And on that second one, how many units was the second one? And maybe if you'll tell us, kind of what were the issues with that one that turned out to be a dud?
Yeah, so that's a good point. So it wasn't an apartment building. So at the time, we did not have a very concise buy box or acquisition criteria. We were at that point, we were like, we want to buy anything that cash flows great, that we think that we can. It was an off market deal that we got, and it was two office buildings. On a Luckily with that one, it truly was in a great location. Just an absolute money location. But there were two, class B neighborhood office buildings, and they were about 40,000 square feet total. And COVID hit, and so I
Yeah.
don't know if we really ever had a lead for that. Looking back on it, for
Yeah.
some of the vacant space there, COVID really froze that for 2020. And then we just struggled in 21, 22 to even we had people moving out, our tenants moving out of their office spaces. And, we kind of got a little bit lucky there too, where we were originally going to partner with an apartment developer to knock them down and build apartments. The location is fantastic, and the city really wants more apartment buildings. So we were going to be a part of that deal. Instead, we ended up selling the buildings, or the land and the buildings, to an apartment developer to go and build a brand new apartment building there, class A with amenities and all that. And luckily, again, we didn't lose an investor dime, but investors did not make very much money at all on that deal, but we were able to get out of it. And that's one thing I would say too about real estate. If you have the staying power, at that point we had started to accumulate more assets, and we had a line of credit still, and we were, we kind of got out of the other one, and then had the line of credit to use on this one, and to float that property along with the management company synergies that we had there, and the vertical integration kind of helped us float that thing along until we could get the deal done there. So, at that point, we were just opportunistic, and we weren't really asset class specific. We had bought, our first syndication deal, and everything up until that first syndication deal had always been residential, like duplexes, three,
Right.
4 units, then the 34 unit. And then we were like, well, let's try to buy these office buildings. These are in a great location. It's like a 13 or 14% cash on cash return in year one. We love it. And then COVID hit, ran into a lot of challenges there. Since then we had bought, we bought a strip mall that we still own. It's in a great location. We bought a self-storage facility, and then we started buying industrial properties. And now fast forward, the last 3 years or so, the only thing that we look at buying right now is Class B industrial real estate, small to medium sized industrial properties like 20,000 to 150,000 square feet. And that's really changed our business as well. While we did a lot of great deals, and I still love the strip mall that we bought. We bought some mixed use stuff as well, where there's retail on the bottom and apartments up top. Still
Yeah.
on that self storage facility. And so, but we realized, and I don't think our investors really loved this, but we were kind of the jack of all trades, master of none. We had the management company that's very well versed in managing apartment buildings, and that was kind of our core um, investment approach. But then we kind of got all over the place. And looking back, I'm happy that we did that too, because we have a lot of experience across different asset classes. There's other, maybe in the future we would begin buying other asset classes again. But like I said, about 3 years ago, we really took a look at our whole portfolio, and we looked at our market, and we looked at macroeconomic and microeconomic tailwinds, and decided that we wanted to focus on industrial real estate. So for the time being, that's what we do now. But I don't want to get too ahead of myself. I know you might add some questions there.
Yeah, no, I think it's good experience that you did jump all over the map. And I think, just in kind of hearing the sizes of some of these, you'd mentioned that you were glad that you kind of went through that adversity at the very beginning. And I think it's good because just like the normal transition, right, with most investors is you start with something that is a little bit on the smaller side. It's not that 39 units or whatever the first one was is necessarily super small, but it's then it went from that to well, you went to the 89 units from there, and so the dollars get bigger, and the impact of those dollars, if they were potentially go bad, gets bigger as well. So I think it's good that you got kind of the mistakes out of the way early. I'm sure there were learning lessons with all of these along the way, as there are with all transactions, right? There's always things that come up and things that we can learn from. But I think, the way that things progress for you are good. And office has always been something that always interests me, as well. So I could have easily, gone down that route as well. So, and sure, I'm glad I did not do that before COVID. So,
Yeah, we closed in December of 19, and
oh my gosh, yeah.
perfect timing.
Oh yeah, and you said that one you actually did get bought out, and they just bought it for the land value. Is that basically what
Correct.
happened there? Yeah, yeah,
Yeah, and we were going to partner on that deal, which was exciting to us because the way that we've looked at a lot of this real estate investing over the last 10 years is investors hate when I say this, and it's not really what we're doing now. We have very deep expertise in our in industrial real estate in southeastern Wisconsin. But at the time, 6 years ago, we were kind of looking at it like our own sort of MBA in real estate investing in our market, and we wanted to learn. We were like, hey, here's a development opportunity. We're not experienced developers. So we're going to partner with this other developer. We can help raise capital. That was one thing that we've always been pretty good at, and get that capital to work, and then they could kind of manage the development process and all the entitlements, all that stuff. And that would have been awesome to partner with them on that. However, the deal was too skinny, right? What we had to sell the land for to help to get our investors out, just made it so that the deal was too skinny for us to be partnered on both the sell side and the buy side.
yeah.
So we decided to not sort of have that conflict of interest. And then secondly, we were just getting too busy with the amount of deals that we had started doing in our core business, which was essentially buying warehouses.
Right, right. And what were some of the differences since you have been in a number of different asset classes? What were some of the differences? And it sounds like maybe your property management being vertically integrated with your partner being the real estate guy. he's had to kind of pivot and learn and change, because all these and how you get them leased up and the types of leases and all that stuff has changed as well as you go from asset class to asset class. Not necessarily dramatically, but in some cases, it's totally different beast.
For sure. Yeah, but that's the thing. We've been always very, very growth oriented. And so us not necessarily knowing, we feel like we've built a great team, and Adam's built a great business within the property management company of really smart, hardworking people. And so we looked at it and said, all right, we're doing this pretty well managing apartments other than that 89 unit. But going through that adversity, we really knew who was on the boat and who's going to row in in the same direction, and who's going to be in it to in it to figure it out, in it to win it. So we felt like we had a great team, and we thought, you know what, there's residential leases that are gross leases, and now we have the opportunity for triple net leases and or modified gross leases and different types of leases. So we knew we had to learn that. And but as you mentioned, there's a lot of differences between investing in apartments and investing in different types of commercial real estate. However, there are a lot of similarities as well. And so the differences, and I tell people this, when I figured out what a triple net lease was, it was like an aha moment. I was like, oh my goodness. All right. So you're telling me that we, can sort of insulate our investment from inflation even more, in the sense that the cost of taxes going up, the cost of insurance going up, the cost of labor and maintenance going up can get passed back on to the tenant. This is like nirvana. And not to mention we can negotiate longer term leases. So rather than having to potentially deal with turning a unit in every year, it might be a 3-year, a 5-year, a 7 or 15-year lease. And so that's something that we've had to get a lot better with. Again, we have a great strip mall that we had bought after the office buildings. It's been a high performing asset for us, but we didn't really know anything about negotiating commercial leases at first. Like, this was all stuff that we had to really dive into and learn, and learn ourselves as well as the property management company learning. And I'm really proud of the way that everybody kind of banded together and approached each new project as a learning opportunity. And then you just kind of get better and better and better and better. And now we have standard operating procedures now, and we have specific ways that we approach leasing out these commercial spaces. And there's lessons that we're learning on a daily basis. I mean, I'm going to do a LinkedIn post about a lesson that we just learned recently, and we've been doing this stuff for a long time now, but you can always get better and better and better. So their experience is certainly your friend.
Yeah, for sure. And industrial right now is pretty hot, for a lot of reasons. And we can talk a little bit about that, maybe what you see as it being now your kind of main buy box and focus moving forward, at least for the foreseeable future, why you've chosen that. What are some of the advantages that you see there?
Yeah. So, if you just look at macroeconomic perspective, I mean, there's an e-commerce boom. There's a reshoring movement for made in America. So we buy general warehousing space, we'll buy manufacturing facilities, we'll buy distribution centers, and then we'll buy properties that are like what you call flex industrial, which a lot of times are like contractor garages. And we have a mix of all of those. I mean, we have an active real estate fund called SIC Industrial Fund 1, which was launched in June of 24. Up until June of 24, we were just buying these properties in a deal by deal basis, each one being their own syndication with different investors. Now we have a fund that we're looking at, blending a lot of these properties together. We've got 7 properties in the fund. We'll have 2 more closed in the next 2 weeks. So, there's the e-commerce boom. There's a reshoring movement. They call it reshoring, onshoring, nearshoring, bringing operations back to America, and particularly like the heartland of America, being centrally located in southeastern Wisconsin. There's a little bit of a lower cost of labor there. We're just over the border from Chicago, so a lot of companies in Illinois have moved their operations up, over the border to Wisconsin as a lower cost of labor and lower cost of living for their employees. There's a lot of innovation happening within automation within these warehouses. And we found that as tenants invest more in automating these warehouses, that innovation sort of gets passed on to the landlord. So sometimes you have these Class A industrial buildings that are really built out with all the latest and greatest. They're super high clear heights, and a lot of technology built within them. But you can sort of retrofit back these Class B industrial properties and warehouses to make them more efficient and automated. And so there's a big movement for that. And what we've found is that most of the development in the industrial space has been focused on the largest, like big box stuff. Like think about Amazon and FedEx as your tenants, these huge warehouses that you see on the side of the freeway. And so as the supply for that has been dramatically, it's like 90% of the development has been focused on that, 85 to 90%. So the buildings that we're buying, which are built within existing industrial corridors, um, there's less of that space to go around. And so as there's less space to go around, the rental rates have been pushed up for those small to medium sized spaces. And not to mention they're in great locations. We're buying them significantly below replacement cost. So typically what we buy, it would cost 3x to build it new today. And there's a lot of rental demand for it. So what we looked at was just a macroeconomic perspective. We like industrial, across the globe. We like industrial in America, made in America, becoming as COVID, ravaged supply chains. More and more businesses wanted to bring operations closer to their end customer and the U.S. consumers. The biggest customer in the world. So being centrally located in the United States to be able to store or make or ship your goods benefits a lot of companies. And we looked at, our market. Milwaukee used to be considered the machine shop of the world back in the day. And so there's a ton of manufacturing here. There's, from a distribution perspective, as I mentioned, it's centrally located in the middle of the country. It's near some major airports, O'Hare, Midway, General Mitchell in Milwaukee. Madison has an international airport, along major rail and major freeways. And then there's a port in Lake Michigan. So there was a lot of benefits there. And that led us to really figuring out that there's in Waukesha County, where I'm at right now, there's a 0.8 vacancy percentage for the types of assets that we're buying. And that was another light bulb moment for us when we had been trying to lease up space in our retail strip mall, which we think is in a great location and it's done really well for us. It's been challenging to find the right retail tenants. But when we bought our first industrial property, and it was Flex Industrial, we bought it 50% occupied. We flipped those two leases from gross leases into triple net leases. We found two brand new tenants relatively easily, both in triple net leases, between a 2 to 4 year term on each of those leases. And we turned around and got an unsolicited offer and had a 4x equity multiple to our investors when we sold that property. And that was a big light bulb moment in that we felt like there's a lot of demand for tenants. So essentially what we're chasing is tenant demand, right? The more that we can find properties in this little niche that we have where there's a ton of demand, we really wanted to just go all in on that at that point.
Yeah, it makes a lot of sense. And that's neat that I've heard a lot of people doing that same thing with the industrial, just changing it from gross lease to triple net. There's still a lot of opportunity to do that in that space, and it's good to hear that the tenants are out there in high demand. And that's an amazing exit, by the way, 4x multiple for your folks.
They're not all that way.
Yeah, of course. Well, that's why you package it in a fund, right? You have the ability to kind of spread the gains and the losses across, or maybe not losses, but just maybe not as strong. What's your overall plan for the fund itself? Where do you foresee that going over the next 3 to 5 years?
Yeah, so the fund model, once we decided to get into the fund business, it was because we realized that we could raise capital. We had brought on a board of advisors that are very well versed in funds. One of them was the controller at I think Bridge Equity Group, which was a real estate fund that ended up going public and becoming a REIT. And then another one has a lot of experience at working in funds at JP Morgan. Um, so the plan for this fund is to raise $20 million. We're about halfway raised, a little bit before, having the fund live for a year. So typically it'll take about 2 years to raise the equity for your first fund. I would say raising equity for a fund is harder than raising equity for a one-off deal, only in the sense that you don't have as much of the FOMO factor. Investors, if they realize that they can get in now or 3 months from now or 6 months from now, they're maybe less incentivized to jump on board when we were raising other deals before. It would be like, hey, I already know that this is going to be oversubscribed, in the next couple of weeks, based on the interest that we have. And so if you want to get in, you got to let us know now. And then, so there's that FOMO factor. But with our fund, we're essentially, we look at it in three sort of pillars: finding great deals, the fact that we are very, very in tune with the brokerage community in our market. It's kind of a niche space in a niche market. Southeastern Wisconsin isn't like one of the hottest areas in the country to invest in, and we know that. It's a great linear market with a lot of yield and not as much kind of wild swings as you might have on some coastal markets or very hot emerging markets, which we like. But essentially, you're in the business of always trying to find great deals and building out what we call our deal flow machine. Then we're working on building out our capital machine, essentially. So we're continually trying to find as many ways and strategies as we can to find investor partners. Now, we don't take any investor partner if they've got a lot of money. We really do still try to make sure that we have interests aligned and that we want to, that we want to have them as business partners too. And then the third leg is operational excellence and asset management. So with this first fund, we anticipate to be raising capital through the end of 2025. We're 100% deployed. So every single dollar that we've raised so far, we've been able to deploy immediately, which is great. The fund is already returning close to a 9% annualized cash on cash return. It's a blend of sort of stable, steady coupon clipper deals, like long-term absolute net lease deals, 15 years or so, along with a blend of value add opportunities where we think, based on what we know, we can increase the net operating income of these properties by at least 20% throughout the hold. And so you kind of have that fundraising and deployment phase, and then you sort of have the harvesting phase or seasoning phase, where you're really myopically focused on adding the value and executing the business plan. We've hired a number of folks to help us with that. So we're continually trying. We would be raising money through the end of this year. We're already ahead of schedule on a lot of the business plans, but there's certain ones that we've got to pick up steam on and add value to those properties. And then you look to exit these properties in years 4, 5, 6, 7, and then subsequently we'll launch another fund. I'm not sure if that fund will be the exact same thesis. Right now, we think we've put personally as the GPs have put close to $1.3 million into the fund, not through acquisition fees, just basically out of our own back pocket. So we are fully committed. But that being said, we will we're in the fund business for the long haul, and so we'll essentially be looking to increase our assets under management and provide great opportunities for investors. Will eventually, looking towards the future, we'll have to figure out other markets to invest in that we like. It'll probably be a mix of Midwestern markets. I think Milwaukee will always be our home base, and Milwaukee and Madison kind of our headquarters, of course, but and where the majority of our properties will be. But we'll have to expand throughout other markets, potentially down in Texas, the Southeast, maybe that Sun Belt region, and just continue to go from there and just keep trying to do great deals and offer great opportunities for investor partners of ours.
Yeah, no, that's fantastic. How can people find out more about you if they want to learn about what you're doing, if they would like to get involved in some of the in this current fund that you have, and hear about the future one that you're going to have eventually here?
Yeah, no, thank you for that. I would say we genuinely want to help people. So even if someone like our fund is only available for accredited investors right now, if someone's not accredited and they want, we have a lot of different educational resources. The best way to find me is on LinkedIn. My name's Geoff Stuhr. It's Jeff with a G, Geoff. It's kind of a unique name. I don't know why my parents did that to me, but that said, I'm easier to find on LinkedIn. I post quite a bit on LinkedIn. I have a 5-day educational resource called The Wealthy LP. If you sign up on thewealthylp.com, you can subscribe to that for free. We do a lot of free content coming from Smart Asset Capital. So if you sign up on our website, you can get access. I think there's 12 different educational emails that explain not only real estate investing in general, but also investing in real estate private placements and syndications and funds, and then also benefits of industrial real estate versus other asset classes. And I'm not trashing any other asset classes. I think there's a lot of ways to make a lot of money in real estate and preserve wealth and build cash flow and get tax advantages. I love multifamily. I still own that 34 unit, still own, I think I have 40 units total of apartments. So I'm still bullish on that. And strip malls, self-storage, I like a lot of them. I probably wouldn't invest in office right now myself unless it was the right opportunity and and I was getting a significant discount and I really knew that market. But yeah, to sum it up, the best way to find me is on LinkedIn and www.smartassetcapital.com. We'll have a new website. I don't know when this will air, but our new website will be live in the next week or two. So I'm excited for that. And we just want to be able to provide a lot of great education and help real estate investors. And I know a lot of people that do this stuff all across the country. So if investors aren't necessarily looking to invest in the Midwest, but they live in Tampa or something, I've got a good buddy that he does mobile home parks down there, and so on and on across different asset classes across the whole country. And we're genuinely seeking to help people.
Cool. No, that's great, Geoff. This has been great. I've enjoyed having you on the Wealth Flow. I've got 2 other questions for you that I ask every guest. One would just be, any advice you would give somebody who's maybe just starting out in their investment journey?
Yeah. The first thing is you have to learn. So, really spending the time to read the books, listen to the podcasts, and just consume information. And that's like a never ending thing. I still try to spend an hour of my day every day on learning. And that could be a podcast, reading a book. It could be, watching YouTube videos. It could be taking a course, whatever I can get my hands on to try to consume information about our business. I try to do. And I think that's very important. And the other piece of advice is to not be afraid to pull the trigger. I think a lot of people, they start learning, and they feel like it's never the right time. And I would just say it's never going to be the right time. I got lucky in 2014 and throughout the teens there where, I bought a lot of great deals that appreciated and did well, but, there's never a perfect time. So at some point, you got to learn enough and then jump in.
Absolutely. No, I think that's great advice. Somebody had once told me on one of my podcast episodes, it's not timing the market, it's timing in the market. And I think that's totally right. Whether it's a good time or it's a bad time, if you haven't been in it, this is all you know. So you're learning at a really good time, to jump in. And so, it's really that time that you spend in the actual market that's going to make the difference. How about a book recommendation? Doesn't have to be real estate related, but it certainly can be. Just something you've read that's been impactful.
Yeah, there's been a lot of things that have kind of happened in my life recently that have made me turn back to this book, but I probably read it 10 years ago. It's called Hard Optimism by Price Pritchett. It's a relatively short book, which sometimes those are my favorites. I read a lot and I listen to a lot of books on Audible, and I try to consume as much information as I can. But sometimes my favorite books are the ones that are concise, to the point, actionable. Sure. And so Hard Optimism is about really approaching your life as an optimist versus as a pessimist. And it's sort of rewiring your brain to become more resilient. So that, when bad things happen, there's a stat in the book about, optimists versus pessimists. It's true that optimists tend to be more successful. They tend to be able to navigate situations. No matter what bad things are going to happen to everybody, adversity is going to happen. But if you look at things from an optimist approach, from a glass half full approach, you're likely going to be a lot better off than if you're looking at things like, woe is me, I'm screwed, right? And, roll over and just let whatever happen. It is what it is, right? If you look at things from an optimist perspective and you've built up that muscle of resiliency, you can usually you can become a lot more solution oriented, and you can find a way to get through pretty much anything. And so I would say it's never as bad as it seems. And unfortunately, the wins usually aren't as good as they seem either. But going through those tough times, whether it's personally or professionally, I think reading that book, Hard Optimism, has been great for me. And I think it's been great for a lot of other people. I hand it out to people quite a bit.
Awesome. I actually haven't had that book recommendation, so I'm always asking for the audience, but I'm asking for myself as well. So that will be one I will Audible it here shortly. So appreciate it. Thank you, Geoff. Man, appreciate this. This has been really good, and thank you so much for being a guest on the Wealth Flow. And I think we will call it a show.
Thank you so much, Keith. You're the man. Any way that I can help you, please let me know. We also haven't been doing our podcast for the last couple of months. We've been so busy, so we're thinking about picking that back up. I'd love to have you on once we get going on that. But please do keep that in mind. If there's anything I can do to help you, would love to do that.
Fantastic.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.